Hey everyone, it is Evan here from thetraderisk.com, and in today's video we're going to be discussing how to trade using daily closing prices. Now, this is a framework that I've been researching, implementing, and trading for a number of years now, and I wanted to bring you this video to lay sort of the groundwork and the considerations that go into implementing a strategy that only uses daily closing prices. So if you're perhaps a day trader and you're looking to extend out your time horizon, or at least maybe allocate some capital or start implementing a strategy that does some swing trading or position trading, this is a good video for you. If you're an investor that doesn't have a active management approach to markets right now, this will be a good video for you as well. And if you're already sort of interested in this topic, then hopefully the experience that I've had over the past number of years can help formulate and really give you some things to think about for your own strategy and implementation that you have currently going on. Now, one thing, we're not going to get into the specific nitty-gritty of strategy, so we're not going to talk about the perfect looking entry or exactly how long you should be holding positions. We really want to focus on this topic of this framework of just implementing a strategy that uses daily closing prices. So hopefully that makes sense. If you're finding this video just natively on YouTube, we do have a blog post that we wrote with everything we're going to discuss in this video, which you can click the link that should be appearing in the top right hand corner now. That'll bring you to our blog post. And if you look in the description of this video, you'll see again all of the links that we mention here in this video and the chapters. So I have the time annotation there, so you can jump to the different sections and chapters we're sort of going to be discussing throughout this video as well. So if you want to jump ahead, jump around, you can do that as well. So I think that's everything. If you guys have questions, comments, again, leave them below, either on the blog post or on YouTube, and I will get back to you as soon as possible. So without any further, let's jump into our video on trading using daily closing prices. All right, we're going to start right from the beginning here and define and ask the question, really, what does trading using daily closing prices mean? So very simply, it is the final or last price that a stock, ETF, or index trades at come the end of the day. So the goal is to ignore the intraday price movement. And if we look at that blue box down there, the tip, it's basically saying, look, forget about the first 6 hours and 29 minutes and only pay attention to the last 60 seconds. That's what we care about when we're talking about using daily closing prices. It's after the market's, been open for 6.5 hours, prices are moving all over the place, buyers and sellers all over the place. Where is the final finish line? What is the final price after all the news was digested for the day? Where did the market settle? That's the price we care about, and that's what the only thing we're going to be using to influence our buy and sell decisions. So this is especially an attractive sort of mentality or framework to use if you have a full-time job. You can't stare at markets all day. You don't have the luxury to just watch up and down waves and candles all day long. You only want to look at something one time a day. It's after the market close. This is something that would definitely be something that you should be interested in if you're looking to be active in the markets. Now, I guess the bigger question is why? What are the other benefits? We just talked about one. If you work a full-time job, this is something that you could easily sort of track and pay attention to. There are some drawbacks. We put out an entire post on this already, so it's an article titled "Why End of Day Trading is Superior." You can head to the blog and find that article there if you just do a search or look in our learning center. But we're going to basically talk about the 30,000 foot views of the benefits and drawbacks here. If you're interested in more, check out that article. So the first benefit is we make fewer but more quality decisions. Now, if you're a day trader, you have to spend all the day, you have to spend your time looking at markets. Maybe you only trade the opening, but you're still going to be there for the first hour and a half and do your homework and, kind of get prepped, and you're trading the markets actively, looking at all of the price movement for opportunity. If you're a swing trader, you could do that same thing. There are plenty of swing and position traders that are looking for things to happen all the time, right? If we're, if some people are looking at breakouts, for example, and a breakout happens at 10:34 a.m., that might be a new entry, even for a swing trader or a position trader or an investor. The difference here with end of day trading is that we don't care about that. We don't want to look at the market intraday. We only want to care about the end of the day. What's that last price at? So for us, then that means that there's fewer decisions to think about. You don't have to constantly bombard yourself. Should I buy now? Is it now? Is it now? You just wait until the end of the day, and then you have your answer. You have that final price. So fewer, but more quality decisions. You buffer against the intraday whipsaw and volatility of the markets. I think this is pretty self-explanatory. I mean, markets are all over the place intraday. There's news events that come out. There's catalysts, right? You name it. Markets are responding to it and pricing things in. And if you're not thinking about that, if you're not worried about that, staring at markets saying, should I sell it now? Do I want to get out of this now? If you just kind of leave that whole mind space and just put it aside, and again, you only focus on that last price, you don't have to worry about some of that whipsaw and that extra volatility. You can have a life outside of trading, right? You save time tremendously, and you afford yourself a life outside of trading, whether it's a day job, whether it's going fishing, doing anything, right? You can do it because you don't have to be chained to your desk looking at those markets. Finally, and this is a very important one, actually, I think this is really one of the first things that got me into it when I was actively day trading back in 2009, 10, 11. Thinking about this approach of end of day trading, it's a natural enforcer of discipline, right? Day trading, you're it's all about managing your own emotions and not making stupid mistakes, not going after revenge trades, not getting angry, not thinking about the last trade. And that can be tough if you're sitting there by yourself in isolation, day trading and kind of taking trades one after another and getting that constant feedback from markets. If you have an end of day approach, again, you only have sort of one time period to make those decisions. And then your next time period is 24 hours later where you start to think about decisions again. So you don't actually have a tremendous amount of sort of self-sabotage on that minute-by-minute basis if you are sort of looking at the charts intraday. So hopefully that's clear. A little bit of redundancy there, but I think those are all very important benefits to implementing a strategy using daily closing prices. Now, some of the drawbacks, missing out on moves because a stock runs away without you. This is a very real thing. Sometimes, you'd be looking at a stock that you want to buy. It's getting close to that buy area. Let's call it Tesla. And you see Tesla starting to move up intraday. And all of a sudden, whatever your signal is, let's call it a breakout. Tesla starts breaking out at 9:37 a.m. Eastern time. You can't buy that then. You actually have to wait, right? You need to wait to see, is Tesla actually going to close at this breakout level so I can then purchase? The downside is Tesla might run 5, 7, 8, 10, 12 points. And all of a sudden at the end of the day, you saw it start to break out at 10 o'clock or 9:37 a.m., but you can't buy it until the end and it's now 12 points higher. So you have to make a decision. Do I still want to own it? Maybe I have to trade less shares of it, so on and so forth. So that's a drawback. Paying up for stocks, again, this is basically the same thing. Paying up for stocks that you could have gotten cheaper intraday. That same Tesla example applies right there. And you're exposing yourself to more risk if you're also using stop losses on a closing price basis. And we're going to talk more about that a little bit later on in this video. Okay, so those are some of the benefits and drawbacks. Now let's get into some of the meat and potatoes of this episode, of this video lesson. And this is going to be around signals, entry signals. So we know what end of day trading is, daily closing price trading is. We know why we would want to do it. Let's say we now want to implement a strategy that takes advantage of end of day prices. So we have a few different considerations to think about and make when we want to execute on our entries, on our signals. Okay, so the first one, this is number one of three that we're going to look at, and the first is end of day trading. Okay, so in that blue box right below me here, there are a few different points to execute on your entries and exits, and we're covering the pros and cons of them in these next few slides. So first thing with this end of day approach is we are looking to place orders at the end of the day before or at the market close. So essentially we're saying all orders are placed in the last 30 minutes of the day when we want to get into a new position. Okay, so let's look at an example. This is an example of the S&P 500. It's just a hypothetical example here, and we're going to use a hypothetical trading strategy. It's a simple breakout system. So if a stock closes at new 10-day highs, we get long, and that's the way we sort of think about new entries here. So in this example, this is a daily chart of the S&P 500, and you can see we got a new closing high above our 10-day highs, and that triggered a new long. The close of the price was 224.02. So effectively, if you're an end of day trader, you bought that close and you got long at 224.02. Now, if you're trading the last 30 minutes of the day, maybe it's 223.94, maybe it's 224.08, but on average, your entry here is about 224.02. So this is an end of day execution method. Okay, let's take a look at another method. This is on the next open. Okay, so let's take a look at what this is. So we're placing orders at the market open the next day. So let's take a look here. Step one would be wait for the markets to close. Run your scans, find out what triggered a new entry or exit for you, and then place the orders to buy on the next day's open. So we're not trading the last 30 minutes of the day, we're trading the next day's open. So on that same example that we just looked at, here's the S&P 500. That prior bar was the breakout bar where we got long before at 224. Now take a look at what happens here. That breakout bar the day before was the entry, right? So that's still our entry, but we're not entering on close, we're entering on the next morning open. And the next morning open in this case is 223.72 because we had a slight gap lower. So notice here, this is a difference in our execution method here, and it's a difference in price, and we're seeing that reflected here. Yesterday we could have got in on the close, it would be a bit higher. This time it's a little bit lower. So again, these are some things to think about. Let's talk about number 3 for an entry signal execution method. This is what I would consider the next day open triggered method. Okay, this is placing stop orders above the signal bar's closing price. So it's very similar to the last number 2 execution method, but instead of just buying blindly the open, we're going to buy something when it rallies above the signal bar's closing price or the highs of the day. So let's take a look here. It's very similar to the previous approach. This is an example of that spider ETF. And again, you can see in this case, we would have never gotten long this breakout trade, because look what happened even after several days of that initial bar where we got long the very first time. It never triggered in this method. In other words, it never exceeded the price, the highs or the close of that signal bar day back there at 224.02 in our original first example. So this strategy gives you, this execution strategy gives you a nice blend of sort of confirmation without waiting for a second close. All right, so let's take a look at how these sort of stack up against each other. If we look here just at that first row, you can see the pros of the end of day method. It's the earliest entry out of all the options, okay? It gets you in the strongest stocks fast. The cons are you potentially get into stocks without that confirmation, right? So especially for breakout setups, traders like to look for that confirmation. So step 1 is basically getting that breakout above some meaningful level, however you define it. And then the confirmation is that follow through day higher that basically says, yep, that's the green light. It is in fact a breakout, time to get long. You don't get that with end of day trading because you're getting in on that first day as opposed to that second day confirmation. Now, as opposed to our next execution method, the next day open, this is the easiest. The pros here, it's the easiest to do homework and work effectively 100% after hours. So for this approach, you actually don't need to look at the markets at all because you wait for them to close and then you run your scans, or you do your homework, so to speak, and that can all be done post-market. You're just looking at where everything closed on the day, and then you're submitting orders to buy on the open the next morning. So you can work a full 9 to 5 job, or even longer. And as long as you have that half hour or an hour to run your scans, or however long that takes you, you could actually implement a strategy that executes on a next day approach. The cons of this approach is you're buying sort of blindly on the next market open. So you're potentially paying up for a stock. Let's say that stock gaps up that next day, you automatically buy the open because that's how you submitted your orders, or that's what your system sort of tells you to, but that may not hold, right? If it gaps up, you buy it at the open, and come 4 p.m. Eastern time, that could be back down and sold off, and it is now below your breakout level, right? You have no idea, you don't know on that intraday time frame that you are actually, getting a successful sort of breakout. The final approach is the next open triggered method, right? And the pros here is that it gives a great blend of confirmation, and it avoids the fake out moves, because essentially what it's saying is, look, I'm only going to get long if price exceeds this signal bar day. So if it doesn't get above whatever produced the original signal, then we don't get long. So it helps sort of give you that, it gives you that nice confirmation that the price is actually moving, the setup is actually moving in your favor. But the cons of this method is that you're guaranteed to have purchased at the highest price. Out of all these other alternatives, this is going to leave you always paying the highest relative price. So when we look at these different methods here, there's no one right answer. They all have pros and cons, and it really sort of depends on personal preferences, the length of your hold time. So in this blue box below here, you can see the next open triggered method. I consider that ideal for multi-week swings or even position trading, because you're less fixated on getting a very exact price, because as we know here, we're always guaranteed to pay the highest price. So knowing that if we have a long enough time horizon, it's actually not going to matter as much. But if you are only trading for multi-day swings, 2 to 3 day hold times, the next open triggered method might actually be a little more tougher, because you're going to give up, you're going to give up 50 cents, $1 or so of paying up for that stock versus getting in on perhaps an end of day approach. The other consideration here is just personal screen time required. Can you actually get to the markets at the end of the day, right? So my method is the last half hour of the day. That's where I put in all of my signals and entries. Can you get to the screen every day between 3:30 to 4 p.m. and place those orders, take a look at what's moved in the market, manage your positions? If you can, that might be a great approach for you. Or if you can't, maybe it's one of these other approaches. So hopefully that gives you some things to think about there on the pros and cons of entry signals. Let's take a look now at considerations for stop losses. Okay, so the same type of thing here, only we're going to be looking at intraday versus end of day stop losses. Okay, because there are some considerations for entries. We're always looking at closing prices regardless. But when it comes to stops, we need to stop and think to ourselves, can we afford to wait until the end of the day if something's moving against us very fast intraday? So let's take a look here at some examples and notes. So just like with entries, there's no right or wrong answer with what we're going to look at. But in general here, waiting for the market to close when a position is falling against you could cause some real damage, right? That should be pretty intuitive. Here's an example, just again, a hypothetical example here in Netflix. If we look at this, again, we're going to use a breakout system, so to speak. And if you look there on the chart, you can see where that pink arrow points to the entry on that nice sort of expansion above that recent consolidation above some of those fast moving averages. Let's assume that was your entry. Let's assume that red dashed line is a stop loss. And now take a look at that very large range candle, red candle that just came crashing down right after the day of entry, came crashing down below our stop loss and closed all the way down at 108.15, or I'm sorry, 188.15. So notice the stop loss was only about 5 or 6 points away, but if we had to wait until the close, it would be almost double the original stop loss that we set out for this trade. So the question you need to ask yourself is, okay, I'm going to execute on these trade setups on an end of day approach, but can I afford something like that happening, right? If I was risking 1% of my account, can it be a 2% loss? And am I going to get out there at the close, or am I going to just put a stop loss in the system that is going to get me out of the trade intraday whenever it happens? If it crosses below that red line, I'm getting out no matter what. So that, again, is the question. We're going to talk about the pros and cons. In the blue box below me, you can see a nice tip here. Again, the shorter your hold time, the more likely you will want to honor stops intraday. And I'm going to tell you why here is because, generally speaking, if you're trading for short multi-day swings, you're generally going to be looking for 5 to 10% profit targets, maybe, depending on what types of stocks you're trading. One day of a very violent day, kind of like this example here, can really hurt you if you have large position sizes and you're trying to capture that 5 to 10% multi-day move, right? That if you have a large position and the market has some catalyst that is causing it to really, fall out of bed and waterfall to the downside, you could be in a lot of trouble. On the other hand, if you're trading for multi-week holds and you're trying to trade for 20% plus swings or something much wider and something much bigger of a move, one day's probably not going to affect you that much because your position size, generally speaking, is probably going to be smaller, right? Just think of it. If you're trying to capture big moves here in a position sizing or a very long swing trading time frame, multiple months, chances are your position size maybe 5%, 7%, 8% of your account per position size. Whereas if you're going for concentrated multi-day swings, you may have 20, 25% of your account in one single position, and that could get dangerous. So those are some things to think about when you're thinking about intraday versus end of day stop losses. It's a question I get all the time. We sort of just discussed this now. If you're trying to score those big swings, chances are one day of selling isn't going to matter as much. The benefit, though, of waiting until the end of the day, if possible, is, again, which is one of the pros to this type of trading system, is avoiding the intraday whipsaw and volatility. So here's an example of exactly that. This is a trade in GBT. I believe we were in this trade at this time. In fact, yes, we were in GBT. And notice on that pink arrow there, if you were to have a hypothetical sort of stop loss at that blue line of support, take a look at where GBT opened. It was way below that support line, that stop loss, if you had it there, and you would have exited that position intraday near the open, and you would have been out of it for, well, it depends where you got into it, maybe a loss, maybe a slight win, but you would have exited the position on that day. Notice what happened, though, 5 days later. It moved, that was the lows, and it rallied from there. It went from $31 all the way up to $38 on that last candle on that chart. So you would have missed the big move, the start to the move that really accelerated it to the upside. So again, these are the things you need to think about. Do I want to be exiting intraday, or do I want to try and maintain in there so I don't get knocked off on something like this GBT example? Special considerations also in the blue box below me here. Earnings day with a poor reaction. Do you want special rules for that? Analyst downgrades, management departures, some fundamental catalyst or some catalyst that's just going to sink your stock. Or if it's something that's really sort of knee-jerk out of the blue, are you going to get out of it in that special case? How are you going to handle that, right? And I don't have any other, actual answers to these questions beyond sort of the advice and what we just talked about with some of these examples. Is it depends. It depends on how long you're going for, how long your hold time is, your position sizing, the overall account exposure that you have. You can look at market environment considerations. So there's a handful of things that you can use as factors. For me, I am always trying to get to the end of the day as much as possible, but I will exit intraday if necessary. Okay, and I have some special rules for that. I'm looking at market environment. I'm looking at some other things, my overall account exposure. Those are things that will play a factor in potentially stopping myself out intraday, but as best I can, end of day is how I like to keep my personal trading style. But again, sometimes risk management has to override and we have to take a stop intraday. So hopefully that gives you some things to think about there on intraday stop losses versus end of day stop losses. Finally, profit taking. Profit taking, same exact considerations. Something that you want to take intraday or something you want to take end of day. Intraday profit taking can save you during choppy environments. Okay, we're going to look at an example in just a little bit. Here's a past trade that members and I took in symbol AXON. Okay, so we're going to get right to the chart there. You could see the entry price. You could see where we got long on that daily closing breakout candle above that trend line, above and through those moving averages. Some nice relative strength on the day, little bit of range expansion. That was our entry there on the enter long right at the close, last 30 minutes of the day. That's where we like to enter. And you can see just 2 days later, it had that huge tail, right? All the way up to 26, north of $26. Notice it had a 10% rally throughout the day, but it only finished up 1.51%. And then notice several days later, it continued to fall and it actually broke down below through support. So this is a situation where if you don't take profits intraday, chances are you never took profits in this trade at all. Right? You probably got in, and I'll tell you what I did in a moment, but you probably got in where that enter long is, and you never took those profits intraday, and then it proceeded to roll over and break down through support, and you exited for a loss, right? That's a very reasonable approach if you didn't do any profit taking intraday. We believe in taking profits intraday. So to recap, end of day entries, end of day stop losses as best we can. Intraday profit taking is something that I am a fan of. Again, no right or wrong answer, just giving my perspective and my thought process here. Reasons for exactly what AXON just did here are reasons I take profits intraday. I try to be smart about the levels at which I'm taking profits, but I like to take them intraday. In this example, we sold twice intraday, one in the mid 25s, one above $26, and we had, I think, 60 or 70% of that position booked. All right, we took it off the table on those two profit sales, and then we did get stopped out on that candle, that very last candle, on that remaining sort of 30% of a position that we had on still, but overall, the trade was profitable. Okay, so that's one example. It's not always that good though, right? There are drawbacks, as there always are. So early profit taking may prematurely trim you out of winning trades, and especially the large winning trades. So sometimes when stocks are really ramping up to the upside, they're going to be super strong. You're going to want to start taking those profits to lock in those positions, to manage your risk appropriately. But if you start doing it too aggressively, those are the ones that are going to turn into 10% winners to 20% winners to 30% winners. And those are the ones where you only need one or two of them a year, or every so months, to really tack on some big gains into your account. So you got to be careful that you don't get too carried away with that intraday profit taking. The perfect is that balance, right? So you need profits. You need to take profits intraday to help you survive through choppy market conditions. But you have to be careful that if you're in a strongly trending environment, that you don't trim yourself out too quick for exactly the reasons we just discussed. You're going to lose those big winners, and you're going to miss out on a lot of big gains. I do have another post there in the blue box below me, recommended reading, pros and cons of trading with profit targets. You can find that in the Learning Center on the traderisk.com. That'll give you some more sort of insights into profit taking and some other tips. So that's what I have for today's video. That's basically the wrap up here. A couple of good follow-up reads. So how to get started swing trading stocks. If you're brand new, or if you're on the newer side of things, you've been trading for less than a year, that's something that I definitely recommend checking out. I got a video version on YouTube, got the blog posted on thetraderisk.com. Strategy development, how to develop simple swing trading strategies. So if you want to get more into the nitty gritty of how do I think about forming the entries now that I understand sort of the points of execution. Do I execute on today? Is it intraday? Is it the next day? Now you can start thinking about strategies. We got that article. It's a video on YouTube. It's also a blog post. And then finally, why end of day trading is superior. Give you some of those pros and cons to that approach if you think this is something that fits your style. Also in the blue box below, swing trading framework. So if you look at that link on thetraderist.com, we have a pretty comprehensive page of how we form our swing trading process here. All helpful stuff. These are all free resources with just a lot of information, detail, examples, and historical sort of statistics for you guys to hopefully put into good use for your own trading. Finally, all these articles, everything, again, linked up below, but Learning Center, traderist.com/learning center, learning-center. That'll bring you to lots more articles, psychology, trading 101, different wisdom, different stuff like that I've posted throughout the years that hopefully you guys will find helpful. So that's all I have for today's video. Again, any comments, questions, leave them below. Hopefully you enjoyed this video, and if you did like this video, then do subscribe to our channel. Keeps you up to date with all the latest that we're putting out. Thank you so much for watching, and have a great rest of your day.